Your entire retirement portfolio could evaporate because you trust a single line of text buried in your prospectus. The industry calls it a disclaimer, but I call it a mathematical trap that bankrupts thousands of investors every year. By analyzing the 2008 collapse and the 2020 flash crash side by side, we uncover exactly why past performance is not just an unreliable guide. It is a ghost. Here is why the math makes your future returns mathematically invisible. Get into it. We are constantly told to look at the chart. We look at the S&P 500, we look at individual tech stocks, and we look at mutual funds that have crushed the market for a decade. We assume that because they did it before, they will do it again. But this is where the trouble starts. Consider the story of the Legg Mason Value Trust. Between 1991 and 2005, the fund manager Bill Miller beat the S&P 500 15 years in a row. Financial news outlets hailed him as the greatest investor of his generation. They called him the man who could not miss. Investors poured billions into his fund because, logically, who would bet against a 15-year winning streak? Then the market shifted. In 2008, the fund lost 55% of its value. That streak of brilliance evaporated overnight. People who bought in at the peak of his glory paid a massive price for believing the past was a roadmap to the future. This happens because markets are not mechanical systems. They are dynamic, chaotic environments driven by human behavior, and human behavior is anything but consistent. Here is your first takeaway. Regression to the mean. It is the most powerful force in finance, yet it is the one investors ignore the most. Think of it like this. If you are a professional basketball player and you have a game where you score 50 points, you are statistically likely to score fewer points in your next game. Why? Because 50 points is an outlier. It is not your average performance. It is a moment where everything clicked perfectly. The same applies to stocks. When a fund or a company has an incredible run, it often means they have stretched beyond their typical capacity. Eventually, reality catches up. A study conducted by Vanguard looked at U.S. mutual funds over a 15-year period ending in 12/31/2020. They found that of the funds that were in the top quartile of performance at the start, only a tiny fraction remained there 15 years later. Most of them slid back down to the middle or fell to the bottom. The winning streak was not a sign of eternal superiority. It was a sign of a temporary advantage that eventually got competed away. Now, if you are finding this helpful so far, hit subscribe. I drop these deep dives every single week, and I have something even better coming up that connects these ideas to your personal decision making. Here is where we level up. This is the second point, and it is about the changing environment of the game itself. Imagine you are playing a game of poker. You have a winning strategy. You bet in a certain way, you fold in a certain way, and you win for 2 years straight. Then the rules of the game change. The deck changes, the players change, or the stakes increase. Your strategy is no longer viable, not because you got worse, but because the context changed. Markets are exactly like this. The factors that caused a stock to rise in 2010 are often non-existent by 2020. Technology changes. Interest rates fluctuate. Government policies shift. Think about Kodak. In the late 20th century, they dominated photography. Their past performance was legendary. They were the blue chip of blue chips, but their success was built on film. When digital photography arrived, that past performance did not just stop helping them, it actually became a burden. Their corporate culture and their business model were so deeply tied to film that they could not pivot effectively to the new environment. Investors who looked at their 50-year history of growth failed to see that the world had moved on. And that is the trap. You are not just investing in a company. You are investing in the company's ability to survive in a future environment that looks nothing like the past. If you only look at the chart, you are driving a car by looking through the rearview mirror. You might stay on the road for a while if the path is straight, but the moment you hit a curve, you are in trouble. All right, remember how I said there was a third method? Something that most investors don't mention but is better than the first two combined? This is the one I have been saving for you. It is the concept of survivor bias. It is the reason why looking at market history is almost always a distorted experience. Most of the data you see in the financial news shows you the companies that are still standing today. You see the S&P 500 index and you think, wow, this index has consistently gone up over the last 100 years. But you are not seeing the thousands of companies that were part of that index in 1950, 1970, or 1990, and then went bankrupt, got acquired, or simply faded into obscurity. They were purged from the list. They are gone. Because the losers are systematically removed from the data, the historical performance of the survivors looks significantly better than the reality of the actual market. It is like walking into a casino, looking only at the winners who are carrying cash and concluding that the house always loses. you are ignoring the thousands of people who walked out with empty pockets. A study by the Center for Research and Security Prices found that between 1926 and 2015, the vast majority of individual stocks in the United States underperformed the market. In fact, a small handful of superstar companies were responsible for nearly all of the market's total gains. If you had picked stocks at random, your odds of choosing a dud were incredibly high. The takeaway here is that you cannot rely on past performance because the sample size you are looking at is poisoned by survivor bias. You are looking at a gallery of winners and forgetting that the failures were quietly scrubbed from the wall. Once you see it this way, you cannot unsee it. Every time you look at a fund's 5-year return, you will wonder what happened to the funds that are no longer being tracked. You will look for the context, you will look for the change in environment, and you will look for the mean regression. That one shift in mindset will save you from making the most common mistake in the investment world. So there you go. 3 real reasons why past performance is a dangerous guide. We talked about regression to the mean. We talked about the changing environment of the markets. We looked at the hidden impact of survivor bias. If you got value from this, share it with someone who needs to hear it. This kind of thinking protects your wealth much more effectively than chasing hot stocks. Subscribe so you do not miss the next deep dive. I am working on a breakdown of how to build a portfolio that actually accounts for these risks, and trust me, it is the logical next step for your journey. Thanks for sticking around until the end, and I will see you in the next one.